Hi, and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I will start by giving an update to my portfolio, and then I will try and answer some questions from the audience regarding passive investing, since I have received some further comments to my episode 51, where I start talking about putting investing on autopilot. And finally, I will share my view on why I'm not doing this myself, but why I still believe that this is a pretty attractive strategy to follow if you do not want to spend the time researching companies yourself. Start with a portfolio update. Well, the first thing we immediately notice is that there was a red circle for this week's episode, meaning that the portfolio is down compared to last week. And if we go to the portfolio values tab, you can see that the value has decreased with a little more than $5,000. At the same time, you can see that the cost has stayed unchanged, meaning that I have not done any new investments. And I mean, a drop of more than $5,000 in a week, that is a pretty significant drop. One of the explanations for this is due to the inflation numbers that came out in the US on Friday, since the inflation has increased from 8.3% and all the way to 8.6%. And this took the market by a surprise, since the consensus estimate from the analysts was that the inflation should have been around 8% and definitely not increasing. And when the inflation is increasing, that means that the Federal Reserve will have to keep doing more, meaning increasing interest rates, and that is not great news for investors. And to put things into perspective, if we look at the S&P 500 from Friday, we can clearly see here that it reacted strongly since it dropped more than 2.9%. And there is a clear explanation for this, since if you are expecting increasing interest rates, that means that cash in the future no longer hold the same value for you as it does today, meaning that you will discount the cash flows harder. So if a company will only be profitable in the future and it is burning a lot of cash today, now all of a sudden that has become less attractive to you. Hence, you're willing to pay less for it. And that is what you see on the stock market. And to put this into perspective of my portfolio, even though that I'm not happy being down more than $5,000 within a single week, well, if we look at the performance of the S&P 500 here, we can see that it is down more than 5.5%. And since my portfolio is down less than 3% within a week, well, then I'm actually still keeping up with the market. Another way of viewing this, instead of just focusing on one number summarizing the entire S&P 500, you could go and look at the S&P 500 through Finvis, meaning now you can see how each category has been performing. Something like technology, communication services, consumer cyclical, consumer defense, and so on and so forth. And what you see here, it's still over in the energy and gas sector, where you have the best performing stocks currently. And speaking of performance, if we go back to the overview and scroll all the way to the top, just so you have the chance to pause the video and see how each individual stock has been performing within this week. If we then continue to questions from the audience, then I have received two questions that goes like this. Would you diversify across different ETFs? And if so, how would you do it? And if you have started your portfolio with a C25 ETF, how would you expand from there? So let's start with the first question here. Would you diversify across different ETFs? And if so, how would you do it? So first of all, my situation is most likely completely different from yours, since I already have a lot of shares individually bought in the United States, meaning if I were to diversify my portfolio, then I could buy an ETF on Denmark or Europe or China, for instance, to have a much broader market exposure. So that would make sense if that was the goal that I was trying to achieve for my portfolio. So perhaps this answer was not so interesting for you, since your situation is completely different. So if we change the question and say, how would I go about this if I had to build a portfolio from complete scratch with nothing in it and only build it with ETFs? Well, I will try to remind myself of the words of Jack Bogle, the father of the Vanguard funds, You can also read his book called The Little Book of Common Sense Investing and say, instead of searching for the needle in the haystack, just buy the haystack and translate it into the world of ETFs. That would mean don't try to buy specific funds that only focus on one sector. Just buy the broadest possible market fund you can find, since that will most likely be the cheapest option for you. But perhaps more importantly to mention is there is no one strategy that fits everyone, since it really depends on how risk averse you are. Let's say, for instance, if you look at question number 2 here, saying that you have started out your portfolio with the C25 since you are Dane, so you feel more encouraged to take exposure towards your home market, since you feel that you perhaps know these companies or brands a bit better, so you feel more comfortable by having this kind of exposure. Well, there's absolutely nothing wrong about this. Just make sure that you're not paying too high fees for it. So if we, for instance, go to Nordnet and find this exact OMX C25, well, this is an ETF that covers the OMX C25. And here you can see you only have a yearly cost of 0.2%. So that is actually quite cheap to get this kind of exposure. Just keep in mind, when you have the C25, that the biggest branches here actually take up a significant proportion of your portfolio, since you have a lot of healthcare and a lot of industrial, and you don't have too much in cyclical and technology if that is what you are going for. But I mean, whatever risk you are comfortable with is completely individual. But if you're buying the C25 and think that you have a fully distributed risk towards the different sectors, well, then you are wrong. And then you might ask, is there something wrong about having a large exposure toward healthcare and industrials? Well, in theory, there's nothing wrong about having this kind of exposure, as long as you are aware about what it is you are doing. Since if this was not your intention, well, then there is something wrong. But there's nothing wrong with having a portfolio with this kind of distribution. This just goes to show there is no one solution that fits everyone. And if I were to mention a couple of things which I look for when I have to try and decide what kind of ETF I would actually like in my portfolio, well, first of all, I want to make sure that the ETF has existed for years. I don't want to be the first to jump the gun and buy something which has just been established. I want to be able to look at a good track record saying, is this fund actually doing what it is supposed to? So if you're trying to buy the MSCI World Index, make sure that the fund has a good track record of doing so for at least 3 to 5 years, I would say. Otherwise, just find something that has that. The next thing that I would look at is the price. How much am I paying for the product? So if you see yearly fees above 1%, I would simply never buy it. And as long as you can get below 0.5 percentage point or lower, well, then I would be fine for that, since you have to pay something for the service that you are actually getting. So let me try and illustrate why I pay so close attention to the yearly fees by using Nordnet's own calculator. So if we assume that we invest 200,000 today, a monthly saving of 5,000 per month, a yearly return of 7%, and a time horizon of 20 years, well, then the 200,000 would grow to 3.4 million. Of course, you have to invest 5,000 per month for that as well. And if we then instead change the yearly return from 7% up to 8%, that's close to 500,000 more. So if your yearly fee would be 1 percentage point higher, well, then your return would be close to 500,000 less in 20 years. This is why these small numbers actually matters a lot in the long run. The next thing to look at, which would perhaps actually be the first, is to make sure that you're not investing your money into something where you do not actually wish to invest. That could be something like tobacco or weapons or handguns, since there are a lot of people who do not wish to make investments into these kind of industries. So if that is the case, make sure to filter those out. So just to try and give an example of a global market fund, well, then something like the SPAR Index Global Stocks really mimics the MSCI World Index, since you have more than 60% in the States, 7.5% in Europe, a little more than 6% in Japan, and so on and so forth. This is of course not a recommendation to buy this particular fund. This is just to show you a really good example of a index that's trying to cover as much as possible with very low fees. And if you look at the different sectors here, you can see that the distribution is pretty different from what you saw on the C25 index. And then finally, we arrive at, why am I not just investing in an index fund like this if I actually believe that this is a good strategy? Well, personally for me, if we just take a look at the biggest holdings here, well, perhaps Apple is starting to come closer to fairly valued, but I definitely still do believe that Microsoft, Amazon, for sure Tesla is overvalued. So just by looking at this, then I would say, even though I think that the companies are absolute wonderful businesses, I do not think that the price that I will have to pay to get them is a wonderful price or even a fair price. Hence, that means since I want to call myself a value investor, I cannot invest into this. And on Nordnet, you just find the 10 biggest holdings in this index fund. If you instead try to Google the ISIN code, well, then you can actually find the more than 1,300 different companies in this particular index fund. And then as a value investor, you would have to go through each individual position to see whether or not you think that these companies can be bought at an attractive valuation. So this is just to illustrate why I do not want to buy into this fund myself, but why I still believe if you do not wish to do the research, you don't have the time, or you simply don't find it interesting, well, then it actually makes perfect sense saying, I have no way of trying to beat the market. I will simply just get the market return. Well, then it's actually a pretty attractive way to do so. So hopefully this answered your questions regarding building a portfolio of ETFs. And here I haven't even mentioned the possibility to do the mixture. Let's say that you, for instance, invest 90% of your wealth into a global market index fund, and then the last 10%, perhaps you start with a sector where you feel you know more, or where you want to have more exposure to and don't mind picking individual stocks, then that's also a possibility. Of course, you can make a portfolio completely consisting of index funds and ETFs saying, well, I just want more exposure to, for instance, healthcare. Well, then you buy an ETF only directed towards healthcare. But personally, I would always just go for the broad market index funds. And if I then want to do research and want to at least get the feeling for whether or not I would like to pick individual stocks, then start with a very small percentages of your wealth and start picking stocks there. So that actually sums it up for yet another exciting week of the Lazy Money Game. So if you have enjoyed the content and made it all the way to the end, I would really appreciate if you would consider leaving a like. It really helps out the channel. And until I see you next time, bye!